Friday's market closes mixed in grains, a higher day in the livestock futures. Joining us is Alan Brugler with Brugler Marketing. And Alan, let's talk about lower start to the day here today, as it looked like we were going to have a risk-off day. But then with this big turn in the stock market, the dollar pulled back. What was going on?
Well, again, I think in the dollar, it's mostly just profit taking at the end of the week. It had been coming up all week. Uh, you saw some fairly big moves against the Japanese yen and against the euro, but the weaker dollar helps the export prospects. We've been talking about inflation for quite some time, but it's not really showing up in the value of the dollar. High inflation should be a weak dollar, and that would be reflected in commodity prices going up in dollar terms. That really hasn't happened because of the Fed's raising rates, and the dollar's an attractive place to park money right now.
Yeah. What's your assessment about the commodity sector? Has it been resilient, or do you feel like it's been resilient while there's been all these recessionary fears and export concerns and whatnot going on?
I think we've been helped by the fact that supplies are a little on the tight side. Having the lower yields in the U.S. for corn and soybeans this year offset some of the concerns we have about the macroeconomy and about the export sales. Corn and wheat export sales in particular are pretty light. Soybeans have been okay, but we've been needing to see some more Chinese business there. A weaker dollar helps that. Stronger dollar tends to hold us back. We do know from a macro standpoint, if the stock market's not good, then the investors, and inflation's high, the investors are going to put more money into commodities. One negative of the market rallying, the commodity market, the equity marketing rallying this week is it probably hurts commodities a little bit in terms of that investor interest.
So we've been range bound in most of the grain sector. Soybeans a good example, 13.50 on the low, 14.25 on the top side. Do you think we're going to stay in these ranges for a while, or what is it going to take to break out of them?
It's going to take some kind of a macro shock, I think. The Ukraine grain deal is one potential play there. Obviously, if those supplies get shut off in November, we know that the rest of the world's going to have to pick up the pace, and typically that's price supportive. We know that's what happened back in 2021, 2022. There are other variables, crude oil, energy. We're so dependent on fuel molecules. Soy oil was the big bull leader this week for the soy complex because it's a fuel molecule, and we're making all this sustainable aviation fuel and all the other products. So that would be another wild card, is if crude suddenly takes off.
And what do you think there? Is crude going to get back above 90, or where are we going with that market?
Crude's kind of range bound right now too. We know that the Saudis and the OPEC plus countries, which includes Russia, are cutting back their production to offset what we're selling out of the Strategic Petroleum Reserve. The government did make some commitments to buy crude at $70 for the reserve, so they're kind of putting a floor under the market a little bit here. But on the other hand, that doesn't control the upside. So the risks are more to the upside than the downside. Diesel fuel's been extremely volatile this week. It got over $4 on the board, and it was back down to $3.70 today.
Yeah, it has been a volatile ride there in that market for sure. So what are you telling your clients right now, or farmers in general, about what they should be doing in terms of marketing? Because we're at the point where, harvest is starting to wind down in parts of the Western Corn Belt, and we've had basis levels which have started to tighten in those areas, haven't we?
Basis is extremely tight in the west, not so much east of the Mississippi. That's a function of where the production is. What we're seeing is very aggressive bidding by ethanol plants and by feedlots in the west to get that cash corn that's in their drawing area nailed down. As we mentioned, corn export sales haven't been very good. So those domestic users don't have a lot of export competition right now, but you can see it coming, December, January, February. So they want to get all those bushels nailed down now. They're bidding fairly aggressively to keep those physical bushels at home, because otherwise they're going to have to rail stuff in from Ohio or Illinois or someplace at much higher freight costs. I'm telling producers, particularly with overrun bushels, take advantage of those strong bids. If you can get $8 cash or something like that, and some of the plants are paying that, take it. But we still think from a price variability standpoint, there's some opportunities later on, and we don't want to sell out here.
So what about this cotton market? It's so sensitive to recessionary fears in the economy, and do you think we're undervalued at this point? Because that's all we've been focused on.
There's certainly a lot of people that think cotton's undervalued because you look at the reduced production, the terrible drought, the high abandonment, et cetera. You'd think that we'd be a lot stronger.
Right.
We are doing a very aggressive export program. I think what we're seeing is that the buyers lined up early to get the cotton that was available from the U.S. They're very aggressive shipping it right now. We just don't have good transparency about what the demand is after that because of the recession concerns. It's been pretty widely publicized that the retailers are having trouble moving surplus inventory right now. Some of that's electronics, but some of it's also textiles and clothing. So cotton has got to kind of assess that, and it's trading somewhat in lockstep with the stock market, hoping that between the two of them, they can figure out what the economy is doing.
So another market that's been pretty resilient during all this has been the cattle market. New contract highs again today in the October for like the 7th day. December finally cracked out a contract high. You and I don't have the cattle and feed report to look at right now as we speak, but what do you think we're going to need to keep that market going?
Well, I think the long-term structure is pretty transparent. The cattle cycle is not topped out or not bottomed out, I should say, not topped out on price. We're still liquidating cows. Cow slaughter this year has been extremely high. Heifers going into feedlots have been unusually high. So we're still in the liquidation phase, which means over time you've got fewer calves, fewer steers, and fewer animals on feed. So that's going to tend to result in higher prices over time. The big question is, are we getting ahead of ourselves here?
Yeah.
We ran the board up to 152 on the D's. Cash is still 147, 148, but on the south, and the board is kind of trading wherever the south is. But my biggest concern for the first part of the week is simply that we did have such a strong run up into the cattle on feed report. We're technically overbought. Will we get a little bit of a sell the factory action?
Yeah, no doubt. We're at 7-year highs on the board, so that could be expected. All right, thanks so much for joining us, Alan Brugler with Brugler Marketing.